Hey, before we get into today's episode, I just want to let you know I'm going to be speaking at the Flagel Small Business Lenders Conference in Orlando at the JW Marriott on September 19th. And not just me, but several folks from the Art of SBA family of shows will be there speaking as well, including our very own Alan Peterson, Sterling Birdsong, and Christopher Hackney, all from the BDO show. We'll be on the business acquisition panel and the BDO panel. It's going to be great content. You know, we don't gatekeep around here. So come on down to Florida and level up your game. We'll see you there. Now on with the show. If you've been following me for a while now, you know I create a lot of video content, and I cannot begin to tell you how impactful it's been for my professional career. If you want to build your brand, there's no better way than to create video content. And my company, The Content Store, helps business thought leaders do just that. I created the Content Store to help folks cut through all the trials and tribulations that I went through and fast forward right to the part where they're producing premium video content. The Content Store specializes in 3 types of content: podcasts, YouTube videos, and short form videos for social media. We believe in 3 key pillars when it comes to creating video content. Number 1, it has to capture people's attention. Number 2, and this is a big one, the video should provide value to your audience. And finally, number 3, we think your content should be authentic and showcase your true authentic self. Let the Content Store elevate your personal brand and begin your content journey today. Go to thecontentstore.com for more information. Hello, and thank you for tuning in to the Art of SBA Lending podcast. I'm your host, Ray Drew. Today, we will be discussing what is perhaps the most controversial topic ever. More controversial than politics and religion combined. We're debating 504 versus 7A for real estate, and we're going to answer the questions once and for all. Are 7A lenders greedy bankers pushing borrowers into a program to earn more profits? And is the 504 process so bad that borrowers should just avoid it like the plague? I, of course, say that in jest because those would be the extreme, embellished arguments on each side. I think the fact of the matter is the 2 programs are very different, and sometimes the 504 is the right product, and other times the 7A is the right product. And I think the vast majority of times today, the borrowers are getting placed into the right product for them. So the point of today's episode is to debate that a little bit and dive into the different factors at play when it comes to choosing between the 2. Now let's start with the 7A. If you're a preferred lender, the process is more streamlined. The prepayment penalty is more laxed. You can include multiple uses in the loan, including goodwill. So there's a lot more flexibility there. And what are you giving up? Interest rate is higher, and you're having to pledge all available collateral. Those are the 2 biggest weak points in the 7A. But the biggest difference of all is leverage, the ability to finance CRE at 100%, and finance special use properties like gas stations and car washes at 90%. Okay, now let's move on to the 504. The 504 has extremely attractive interest rates, which are typically fixed, including a below market fixed for life component. Compared to conventional, borrowers will put less money down on a 504, anywhere from 10 to 20%, depending on the property type and whether it's considered a startup. You can also get a nice 25-year amortization. But aside from interest rate and not needing to take additional collateral, the 504 doesn't seem to have any other advantages over the 7A. We'll debate that. The prepayment penalty is harsher. The process is more. You can't include other proceeds like inventory and working capital. So to me, what this comes down to is leverage versus interest rate and what's more important to that specific borrower in their specific situation. And first of all, not all borrowers have 10% to put down. If a borrower has equity in their business, though, on their balance sheet, we as 7A lenders can allow the small business owner to leverage that equity and obtain 100% financing to buy real estate and expand. But if that small business owner has that 10% sitting there and they don't absolutely need it for anything, and using it isn't going to slow them down, well, it's hard to make the argument that the 7A would be better then. The safer route there is using a 504, getting a much lower interest rate in those cases. Now, in terms of what 504 and 7A lenders will approve, I feel like there is a difference. I feel like if there's more reward to be had with the 7A, I would think a bank would be open to taking on more risk with the 7A. This would come into play on your Harrier deals, some projection-based deals, and maybe some special use deals. Size limits are another factor weighing in on the debate. You can finance up to $5 million with the 7A, but with the 504, you can tackle much larger projects, up to 12 million and beyond, really. And you can do multiple projects if you do energy efficient stuff to your buildings, basically. So with that, I'm going to open this up for debate. I'm going to introduce here our panel of Art of SBA contributors: Charles Green, Senior Vice President at Harvest Small Business Finance; Ken Rosenthal, Senior Advisor at Momentus Direct Capital; and Brooke Mirenda, President and CEO of SEDCO. What a diverse panel, by the way. We have a CDC, a 504 wholesale buyer, a BDO that can do 7A or 504, and me, just a 7A lender. Brooke, I'm coming to you first on this. How do you describe the differences between these two programs when it comes to real estate purchases for small business owners?
Well, first of all, thanks for including the 504 in this, Ray, because I know you're the 7A guy. So I really appreciate the opportunity to talk about this. The two, you've addressed pretty much all of it. So when we're talking about 504, we're like, okay, what's the majority of the use of proceeds? Is it real estate? What is the borrower needing to do? And so understanding that, like you said, is the most important thing. I mean, if they plan to sell their business in 2 years, you should do a 504. So I guess it's just a matter of 504, fixed assets, real estate. Yeah, I'll tell everyone that if it's typically a 504 versus any other product, we're going to find, it's usually the best thing for the borrower. But again, it depends on what the borrower's needs are. When I'm doing training for bankers and things like that, and I'm explaining the differences, I actually have a 504 versus 7A because I joke that the 7A is our biggest competitor. It's not, another loan price, it's the 7A loan. And so when I explain it, I say, the 7A is kind of the umbrella loan. It can finance everything. And I usually say including your firstborn, like anything and everything that you want to finance, you can do under the umbrella of a 7A. However, your rate and term aren't going to be as attractive. And so, we're dealing with right now in the 504 space, getting a lot of clients out of 7A who are, rates went up 5% in like 13 months. That's a big deal. So when you're in a variable rate, that can be challenging for these small business owners, especially if they're tight on cash flow. And so when I explain it, I just say it's an umbrella loan that can finance everything. You're gonna need additional collateral, typically additional collateral, which on the 504, because we only finance fixed assets, that is our collateral. So there's limitations on what we can finance through that. And then I also explained to people, you can do a 7A and a 504 at the same closing table. Someone's buying a business and the acquisition is, a small portion of it, and then they're doing a large real estate deal. It is in their best interest typically to do the 504 as real estate and do a 7A for the business acquisition. So again, it really depends on the client profile, what they're looking to do. But of course, I'm going to always say that the 504 typically in most cases, when you're comparing the two, because we do the comparison tool, is usually the best product for a small business owner.
Interesting. Ken, did you have anything to add to that in terms of the just kind of differentiating between the two?
I do. So as you know, you introduced me as wholesale, which I have been for the last 14 years, but I was retail for 20 before that. And I used to say there's 5 ways to buy real estate. Pay cash, quick conversation. Seller carryback, quick conversation. Conventional financing, which obviously requires more down payment, and the 2 SBA programs, 7A and 504. And then I'd lay out the pros and cons of each. And unlike a lot of 7A lenders, 504 lenders typically would throw out all options and say, here, you choose. What's best for you? And it really does depend on the situation. So most cases for 504, if you're going to be in the building for 5 years or more, it makes more sense, long-term financing, to go 504. I mean, we're talking 6% on the debenture. The first mortgage can be as low as 6.5 fixed for 25 years. The debenture is 6 fixed for 25 years versus prime plus anything. Obviously, there's not a decision, right? Do you want 10 variable or 6 fixed? Let you think about that for a while. No, I mean, obvious, but if it is a short-term need or there's a bunch of other things that need to go into the project and you can't for some reason do a companion 7A, which is really probably the best case if you have mixed use, not mixed use building, but mixed use of items to go in the project. You do a 504 for the real estate and you do a 7A for everything else, you get it all.
Charles, do you see it any different you can offer both. So how do you present these different options to your customers?
Just slightly different, actually. I think, well, and first of all, I have been a 7A guy most of my career, and my first SBA 7A was in 1984. But that said, in 2004, I was the founding chairman of a CDC in Georgia. So, I understand both sides of the coin. But I think what gets lost inside is that there's different SBA borrowers. You both mentioned different needs, but also just there are borrowers, then there are borrowers. There are people who are buying a $10 million project and who can negotiate a 6.5% first mortgage on top of their 6.02% debenture. And then there are those whose experience, whose capitalization, whose success of their previous business are lucky to get prime plus 3. And that's the market I've been living in most of my career, where dealing with a lot of smaller people flying closer to the earth. And to be clear, I haven't done anything except real estate loans for the last 10 years. So I don't do business acquisitions and I don't finance working capital and so on. But it's just getting in that real estate project. There's a place for accepting more risk, working harder to get that borrower qualified, holding their hand well before the loan application is prepared and submitted, and holding it after they're long gone. And some of the benefits I get out of that, by the way, is, in the last 5 years, I've done 5 loans for one client and 4 for another. I don't think there's a lot of 504 borrowers to go through that experience, because you are competitive and you are going to get the best deal for you. And the difference in the high pricing that I get is the service delivered.
Interesting.
Can I jump in real quick?
Yeah.
What you just talked about, I think, in lending is called risk-based pricing. So I think you're right in that the better, higher quality borrowers are going to go 504. The ones that need more hand-holding, that's a riskier type of transaction, are going to go 7A. That's risk-based pricing. Higher risk, higher pricing.
Unless they don't ask.
Okay.
That brings up Ray's greedy banker issue.
I'll reflect on that a little bit. There's a lot of ways in which greed enters the marketplace, and certainly that's ripe in here. But I don't think choosing to sell the $5 apple versus the $3.95 apple is just pure greed. It's what I sell best. I'm working on 504 closing right now, and part of the pushback on 504 for me is just process. Like, the Byzantine calculation of collateral value is such that this guy was $20,000 short of being fully secured. Well, he has to come up with $20,000 more or give a life insurance policy. Well, he has a life insurance policy. It's got to have a term of 10 years on it. It's got a term of 8 years. So we got to go to Washington and say, Mommy, may I, put this $300,000 policy up for a $20,000 requirement.
Did he have to pledge his house?
No. But I don't pledge. Hey, we don't pledge any houses or take insurance on real estate loans either.
If you've been a fan of the show for a while, then you know one of my favorite companies to work with is Rapid Business Plans. Last year alone, their business plans helped facilitate over $600 million in government guaranteed lending. They're on track to beat that this year. More and more small business lenders and their borrowers are relying on Rapid to help with the business plan, projections, and assumptions, because their team goes the extra mile to ensure everything is done fast and done right. And that helps streamline the process. They're great at export business plans, by the way, which are critically important at protecting that 90% guarantee. Rapid also offers feasibility studies, which tells you if the project is, feasible. I would recommend these for any large startup loan because it protects you and it protects the borrower and helps you get more good deals done. Go to rapidbusinessplans.com to set up your Get Acquainted call today. Find out why so many top producing BDOs recommend Rapid to their small business borrowers. We're going to leave a link in the show notes just for our Art of SBA listeners. Now let's get back to the show. This is taking an interesting turn. I didn't fully prepare for this. These are not my questions. But I got to go to Brooke here and just get her way in because some of the stuff that Charles is saying.
So yeah, we've experienced that. Exactly what he's saying? Because you get the liquidation value, and you're like, oh, you're just a few $1,000s short, and that's what you do. You go to SBA and say, listen, this is, with 1 year's worth of payments, it's the value is going to be there. So you can certainly, fight that a little bit. The life insurance issue is it's a hot button for us because the reality of it is we are financing a fixed asset with an appraised value that is sufficient for what we're doing. And so that is what is really challenging when, years ago, it was not a non-issue. And it was just like, oh, now SBA is making this an issue with life insurance. So it's liquidity value. So we'll sometimes go to SBA and say, this doesn't make sense for our borrower to have to go through this. And, life insurance, you get it and then you just stop paying it 3 months later and then you don't have it, which is absurd. But that's what borrowers do. And so you just I'd rather just be straight up on the front end and say, listen, this is, it's so menial. Let's not include it. So you can, as a CDC, you can say, listen, we're not going to include this because of XYZ. So you can mitigate it in a credit memo to, again, argue your way as to why we would think that they don't need life insurance. But then that does happen. But yeah, the closing funding process, I think the biggest thing Charles brought up is the closing funding process. I think that's where it's, I think, tougher because that process gets, we always try to attend every closing because that's where it gets a little hairy for borrowers and bankers if they don't do them very often because it's, a 7A is done with the same lender. You fund it, it's done. Whereas a 504, you got,
two-stage
bank loan, interim loan, CDC loan, and SBA. And so there's so many.
Having flashbacks.
Yeah, there's so many things that happen. The closing funding process. And if that's your last experience with a 504 and it's confusing and convoluted, you're not going to do a 504 again. Whether, it doesn't matter the CDC, that loan program is not going to be, whether you're the banker or the borrower, you're not going to necessarily like it. So, we really try to hone in on that closing funding process to make that as seamless as possible because that's where it can get clunky.
Not only that, but you talk about timing. And there's a lot of times that, hey, I got 20 days to close and a PLP 7A lender can get that done and 504 can't. And so every deal is different. You have to ask the borrower and find out the full story behind it. Timing, what are your needs? What are your goals? Why are you doing this? What are you going to do in 5 years? There's a lot that goes into it, not just one or the other. That's why you should present both options and see what's best.
And I want to go there actually next. So let's dive into that a little bit, Charles, and kind of really dive into the different factors, the different questions bankers should be asking to try to figure out what's better. Let's start with prepayment penalty, Charles. Like, how does that weigh into the decision-making process? Like, what are the scenarios where prepayment penalty matters and when does it not? Take me through kind of like the borrower's decision-making process on that aspect of it.
Well, to a borrower, my experience is any prepayment penalty is a boogeyman. So even the 531 or the 7A is, they have to think about it and they don't like it and how do I get out of it and so forth. And it's kind of like, unless you win the lotto, why are we having this conversation? If you win the lotto, what's another $50,000? But with the 7A, the 504, the 25-year is an easy thing to sell against for that reason. The 10-year winding down. And even with the conventional options, my company is not a bank. So we're having to buy that money somewhere else. And it comes with some 3 very unattractive options unless you want to just buy it away with a higher rate, which starts to really get in the nosebleed section. But I don't think prepayment, it's part of the sell or sell against, but it's not the whole deal. I think interest rate is really more where you are. And I want to go into that when you're ready.
Okay. We will get there. Brooke, what about the whole additional collateral aspect of the 7A? How big of an issue is that for small business owners? How should they be thinking about, a lien being placed on their house, for example?
I would say that it's become a lot bigger deal since we're now able to refinance out of 7A. That is one of the main reasons borrowers are trying to get out of 7A. While their rate is high, and that certainly is one, releasing that additional collateral, assuming the lender took it as an abundance of caution. Us flipping it to a 504 and releasing that collateral is vitally important. Part of that, sometimes you've got owners that one owner, they took the house of one, and then you've got the wife that's now on the 7A loan that had nothing to do with it, only because she was the owner of the house. And so there can, SBA does not like releasing guarantors. So when we're doing like a refinance, and that's where I would say my experience has been, because, we don't take extra collateral, so it's a non-issue for us. But when we're flipping to it from a 7A to a 504, one of the biggest things is get rid of that extra lien on my house or whatever. And it might be, one owner, the lien got placed on one owner's, not the others, and or the wife is now on the 7A as a guarantor, and they have nothing to do with the business at all, and they were placed on there as an abundant, because they're on the house. And so in SBA, that's the one thing they don't like us or allow us to get rid of a guarantor on a loan. And so that's where it's kind of come up. But yes, that's every I would say every 7A loan we've done, and where that's happened, they're asking to release the additional collateral for sure. Yeah. And usually the collateral we're doing is sufficient for what we're doing. Go ahead. Sorry, Charles.
It could be a husband, not just a wife. So just.
Oh, I'm sorry.
Oh,
sure. You're right.
Hey,
we said it'd be controversial.
Fair enough.
When you get a moment, I want to circle back on prepay, because I don't think we finished that.
Yeah, go for it.
Can I? So in the business that we're in, we're really in education. So we're not in sales. And educating the client on what does that prepay really mean. So on the second on a 504, you can't make extra payments, correct. But on the first, you can pay 20% per year with no penalty, which means you can almost pay off in 5 years. So the prepay may or may not be a factor. It's why is the prepay a factor? Are you thinking you want to sell the building in 3 years, or you just want to make extra payments like you do on your home loan? If it's the latter, then no issue. You just pay down the first because it's more expensive anyway. Even my 25-year fixed at 6.5 is more expensive than the debenture 6. So just pay the first down. So it just depends on what your goals are.
Yeah, it has to. Yeah, I think that conversation around prepayment penalty has more to do with, like, do you plan on keeping this property for a long time, or selling it in just a couple of years? So
if you're going to flip it, 7 days better for you.
All right, Ken. So in terms of cost, break it down for me. 7A has guarantee fee, 504 has origination fee. Obviously, the interest expense is a big cost. What product is going to cost more, and how much more?
So there's two components: interest rate and your cost that you're paying that you can finance. So the costs that you're paying you can finance are the guarantee fee on the 7A. On the 504, it's your cost for the debenture is built into when they sell the bond on Wall Street. The SBA guarantee fee can be financed in the bridge loan. Any origination fee can be financed in the bridge loan. So the total cost is similar. I would say 7A is a little bit higher.
Okay.
Interest rate obviously is where the true rubber meets the road. What is your monthly payment? So when I talk to people, it's like, yeah, okay, they always want to talk about interest rate. It's like, that's great, but what's your monthly payment? That's really what it comes down to. True. If your monthly payment is $4,000 on a 504 and $6,000 on a 7A, and both are 25-year loans, that's the key, because all the costs in both programs can be financed. So I think the cost is a little bit higher on 7A because of guarantee fee, but I think it's a moot point. I think that the payment is where it really matters.
All right, Charles.
And it's a fixed payment on the 504.
All right, Charles, let it rip.
Well,
come at me.
Ken, I don't know if you knew this, but you can actually do a SBA loan under $1 million.
I don't have a minimum.
Zero.
I've done 100,000.
Zero guarantee fee is the point, and so that's a caveat that has to be looked at. And I'm in kind of a narrow market. I choose to make loans to childcare centers, for example, and 50% of them are under $1 million. So that's not a point. And if we want to get a little tighter, tighten the belt a little bit more, if you go down to a $600,000 sale, I don't think the CDCs, they may not be able to admit it out loud, but they don't really want to deal with a $600,000 project, do they? You don't have to answer, Brooke. But I mean, it's just, it's a
I'll
lot of
answer.
work.
I'm happy to answer.
It's a lot of work, as is, 504, it's twice the amount of effort. So if I'm a BDO originating this, I've got to do 2 loan applications and answer to 2 different, needs list and responses and manage that whole process all the way through closing. So
Not if it's done right.
that's part of the cost. Now, interest rates, though, it's easy to say, today let's just jump on the horse and talk about it. But you have to remember, interest rates go up and they go down. And while they started rising up most recently in, I think, March of 2022, and we were expecting by June of 24 they were going to start falling off based on the Fed chairman's remarks this spring, but they haven't yet. But that said, I think today would be a terrible time for somebody to close on a 504, because I do believe we're going to expect to see some rate cuts as early as September. And I don't think it'll only be 1 rate cut.
How many rate cuts do you need to go to get from prime plus 2 3/4 to 6?
Depends on how fast you cut. But do you want to get
like
stuck?
14 rate cuts?
Well, let's
I was
just
gonna
say,
say it's a lot. It's a lot.
I did a 504 at the borrower's insistence in 2018, and I just told him the truth. If you mainline prime rate and pick a margin and compare it to fixed rates over the last 30 or 40 years, in a 25-year term that you're outstanding at least 10 years, it's all going to wash out the same. And depending on where you get in the deal and out of the deal, what cycle you're in, their chances are just as good you're going to get stuck paying a higher 504 rate because it's fixed than when prime goes down and you would have had a lower rate at 7.8.
Look, today it's not a fair fight, right? Because this is not normal times when you have an inverted yield curve. So it's not a fair fight saying the debenture's at 6, prime's at 8.5. It's not a fair fight. You look over the long term, and Charles, you're older than dirt, admittedly, you know that over the long term, typically they're similar. So it goes back to, where are you in the cycle? How long do you want to own the building? We know the average life of a real estate loan is 7 to 8 years. So in the cycle that you're in, you have to look at what is appropriate in that 7-year cycle. Treasuries are under 4. Look in history. That's really pretty darn good. Treasuries typically, on average, over 50 years are higher than 4. People are just saying it's high now because of COVID, because they have short memories. But right now, fixed rates are very low. Variable rates are very high. That's not normal. That's why people are taking advantage of it today.
I want to just see if Brooke wants to come in here and say anything before I pivot to this next point. Did you have anything to add to any of that?
Yeah. So Charles is talking about, whether we do a small loan. The answer is yes, but it really comes down to, is it cost prohibitive to a borrower too? So we'll look at it and go, listen, the fees just aren't worth, if the debenture's too low, the fees just aren't worth it. And so, keep in mind with a 504, we're always working with a lender, which is typically a bank, and our relationship is there as well. And so if the bank really wants to participate this out, we're a partner with the bank. So, or, non-bank lender, whoever it is. And so there's that component too, that's a little unique than, just your own 7A shop. And so that's where, it can kind of come into play, where the bank's their credit risk won't allow it to go any other way than, a 504. And so, I think our smallest debenture we just did when it was like 127,000, like it was tiny. That was the debenture. So it was like a $300,000 loan. But you gotta run the numbers and figure out even if it's worth it for that borrower. And sometimes you'd made a comment about like 100% financing, and I've been asked, like, how do 7A lenders do that? Like, I'm like, well, the guarantee is the same. They still have the same guarantee. The lender's just putting out more money because maybe it's a better deal, or they're willing to take on that additional risk. And, because they're getting the 75% guarantee, they're willing to take on additional risk. But in 504, depending on the CDC you're working with, you can do 100% financing too. So there's some deals we do 100% financing as well. We just do it behind
Interesting.
the 504. And that's allowed. And so to say you can't do 100% financing in 504, you absolutely can. If you're working with a CDC who has the capital to be able to fund that on the back end. I mean, you could do a seller's note too. So again, there's ways to finance 100% in a 504.
And are you talking about a $600,000 project or a $6 million project?
Smaller.
It's different.
Yeah. Again,
right.
Smaller, absolutely. But I'm just saying
Yep.
there you can do that. So again, it just kind of depends. I mean, we have some where they're, the project's $750,000 or, $1 million. And, if you're talking about a difference of $100,000, if I need to put that on the back end of a 504 to help this borrower, we would do that. And my rate and term, like SEDCO's is very attractive. So again, there's ways that we work, because again, we're working alongside a lender. So it's a little bit different where we're not just out there on our own doing our own thing. Like we are working alongside a lender, in all of these projects. So it's a different relationship.
Yeah.
I mean,
and let me just follow with that 100% thing. There's a graveyard out there somewhere about 100% financing. I think it's called Money Store. Is that what? I personally don't believe in it.
It's before raise time.
And my house doesn't do it. I mean, they don't do it at Harvest.
Charles, we're supposed to be on the same side here, and I will say, 100 take on more. This is ludicrous. Take on more risk. People do $5 million business acquisitions with zero collateral. Going from 90 to 100% on a building is nothing compared to the risk of those types of scenarios.
Yep. And it depends on what
Agreed.
the situation is and what the borrower's looking to do. It doesn't happen often, but it will happen from time to time. And that's what I'm saying is sometimes I'm like, well, you can do 100% finance. You can, just like 7A lenders can do 100% finance. I know a lot of 7A lenders that will not do 100% financing. So, what is allowed and what's not allowed.
That's why we're advisors. And we give advice to the client. You learn about their project. You learn about their goals. How old are they? What's their succession plan? I mean, there's so many questions that go into it. It's not just so simple as 504 or 7A.
And by the way, the interest rate argument is not one I personally partake in. I think it's pretty clear that the 504 interest rate is better. But the big difference for me is when I'm doing a 7A and I see a high interest debt on the books, or they need a little bit of inventory and working capital, I'll just throw it to the proceeds, and that's going to get amortized over a 25-year, term along with the real estate. And, that's saving them money. So you're kind of getting it from somewhere else, essentially. So
it's true, but that's knowing the whole story.
Is there anything you guys
just depends on the situation.
Is there anything else you guys want to cover in terms of the, the different products and features of each program before we move on to round 2, believe it or not? And there's supposed to be 6 rounds here. Oh, no, round 3. That'd be round 3. Let's just move on. So Ken, there's a wholesale market for 504 and a secondary market for 7A. Obviously, 504 wholesale market is less lucrative. Do you think that if banks could earn as much money on 504s as they can with 7As, that 504 lending would increase?
Well, actually, they can, but no 504 borrower that I know is going to take a prime plus 2 3/4 first mortgage. Again, it goes back to risk-based pricing. We're dealing with higher quality borrowers. Therefore, the rates are typically going to be fixed for, we do 25-year fixed in the 6s. Our premiums are, say, 3 points on the first mortgage. Charles is doing prime plus 2 3/4. Prime plus 3, sorry, and getting net 14. You're talking about apples and oranges, so it's completely different. 7A, you're doing 90%
net 12,
financing.
Net 12.
Yeah, okay. So 504 on the first mortgage is all we're paying on. You don't get paid on the second. So do you make less? Yes, but it's not necessarily about that. In the 504 world, and remember, I work for a nonprofit, it's what is best for the borrower. What is best for the small business? Brooke works for a nonprofit too. So that's the common theme on 504 is what's best for the borrower. As a bank, you can do what's best for the borrower, keep the depository relationships, make some money as well, and give the borrower a fabulous rate. So it's a win-win.
Yeah, and just for the record, I work for not-for-profit myself now. So anyway, hold on. I'm going to go to you, Charles, here. So because the bank is earning less on a 504, the BDO is paid less as a result, and perhaps has to put even more hours into getting it through the process. So how should BDOs be thinking about this? Because you've got to do what's right for the customer, but you also have a self-interest there.
I agree. I'm from that old school where ethics in banking It's very important, and I'm conscious of it all the time. And I don't know that that's a prevalent thing. I don't think it's really emphasized enough across our industry. And I say that having trained a lot of bankers over the years and written about banking quite a bit. But the bottom line is your client deserves your best judgment. And it's kind of, as Ken alluded to, advising them on their options and strategies and justifying why you take them the way you take them. And they can push back and they want to do the exact opposite. You kind of have an obligation to do what they want to do if that's how they want to do it. That leads me, again, with the client base that I'm serving. That leads me to through 7A most of the time.
Okay. Well, so let me ask Brooke this. So do you think that bias exists with all of us, whether intentional or unintentional? Like if I, as a 7A lender, or you as a 504 lender, explain the differences between these two products to a borrower, do our biases come through? And is that essentially, does their decision get swayed because of how we're explaining it?
I hope not. I mean, if I hope's not a strategy, but I hope not, because again, there's times where we'll work with lenders. There are lenders we work with, very large national lenders, that fix their 7A. They're not selling in the secondary market. So it's a very different product than what Charles is doing. And so, and they do a lot of 504s, and I won't name any names. So again, they're doing a cost comparison on even fixing the 7A. They're, again, not selling it. So they're not getting that premium, which is what I think over 80% of 7A loans are sold in the secondary market or something like that, a very large number. And so, we work alongside these national banks that are not selling, and yet the 504 is still advantageous for the bank and the borrower. And they'll do they do cost comparison tool. Here's 7A and here's 504. And they work alongside, the borrower to determine what's the best. And sometimes we're there and sometimes we're not. But going back to your question, I hope not, because again, there's times where there'll be a deal that Ken brought this up, and maybe Charles did too, where it's just too hairy. No lender's going to go in a 50% first lien position on this deal. It's too projection. The projections, they don't cash flow for 2 years, and now the projections are crazy. So you stick with a 7A lender is going to run it maybe under PLP, and it probably shouldn't be done in the first place, but whatever. That happens. We all know it. And so that's what I'm talking about. So again, it's like there are deals that are all real estate that should all go 7A, because there's no way I'm going to find, or there's going to be a first lien lender that's going to take on that risk, because it's the risk profile is just too high for that lender. So I always keep in mind, we have, again, that lending partner that, is effectively approving the loan. We sometimes have the approval before them, a lot of times. But again, we're working alongside the lender. And so that's a little bit of a different situation. And knowing that I am working with these large lenders who are fixing 7A loans, and they're still choosing the 504, tells me what I need to know about the differences between those programs. And we're not trying to be biased about it. We're like, if the 7A is better for you, then that's the better deal for the borrower, for sure.
Well, and I was going to ask about this, and I want to go to Ken here, because I've seen banks doing like prime minus 1.7A deals, for example. Like, why not just do a 504 at that point? Like, why would banks even want to do, crazy low fixed rate 7A? It just seems like it's not, I don't understand it.
They may want to just hold it on their books. You're talking about the ones that are doing that are not Ray Community Bank or Ray Credit Union. They're the large national banks. So they want to take the 90% loan and hold it on their books. And if you do a fixed rate 7A at 7, maybe in their model that works for Chase, but it doesn't work for Ray Credit Union. So it just depends on the institution and the borrower. Then borrower's got to say, okay, I have a 7 fixed 7A, or I can do a 504 that maybe the blended rate is 6.25. So rate is not necessarily as critical in that situation, but I think that's more rare.
Okay.
It's typically prime plus versus fixed rate.
Can I jump in on that, Ray?
Sure.
We're talking about the money center banks. So Bank of America, Wells Fargo, Citi, Chase, those who can go out into the commercial paper marketplace and pick up, $5 billion at 3% for 30 years. And they'll use it as bait to draw a lot of new business in. They're not making the kind of 7A loans I make. They're cherry picking more like Ken, your customer. And
right. Risk-based pricing.
Yeah, at one below prime. So that's 7.5 fixed for 25 years right now is a pretty damn good deal without the hassle of 2 loan structures and a lot more closing requirements and so forth. And if you've ever run the numbers, holding a 7A loan on portfolio is the smartest way to make a 7A loan. You earn a lot more money. Now,
if they go 25 years,
even if you go 10 years in the modeling I've done, but even if what they have different is they're not paying the commissions that the BDO marketplace does. And y'all were talking last week around origination sourcing, and they've got the extensive branch network, and someone from Midtown refers a deal to the SBA center, and lo and behold, it gets done in 90 days. They turn down 90% of the applications, but that whoever referred it gets a $250 bonus, and everybody's happy for it. That's not the world we live in.
Yeah.
But no. Don't get me started on compensation. What we talked about last week is like crazy difference between 504 and 7A as far as the BDO, what they make.
Oh, yeah. And keep in mind, SBA makes a decent amount of money from 7A too. So we talked about that, Ray, on our last one. So again,
hey, y'all need to stop pocket watching. Get out of here.
I'm just saying, like, so let's, call a spade, but again, just to Charles' point, yeah, I mean, if you're selling the secondary market because you need the capital, I do Community Advantage, so that's I'm a CA SBLC, if you know what that is now. So we do loans up to $350. I sell them in secondary market, by the way, price them all the same, and we're kind of bridging that gap of the smaller dollar loans and I'm doing it for capital purposes, which is why a lot of 7A lenders sell the secondary market. It's not necessarily because the premium. I mean, yeah, that's a nice little nugget on your net income. However, the reality of it is, as Charles just mentioned, if I'm looking at interest rate prime plus 3, that interest rate's pretty darn good on the full loan. If I can, keep that rather than selling and getting that small premium and only keeping the, 15 to 25% on my books, which is what we do now. And there's, as you can participate a portion of it too. So there's a lot of things that these 7A lenders, they're not necessarily just selling that 25% piece. They can sell another 15% on top of that. So you got some of these large 7A lenders, it's probably what they're doing to earn more money and get that premium, not premium, get premium, but also get that capital back to then re-lend. So it just becomes a faucet of re-lending.
Right. That's a big part of it. And Brooke, I want to stay with you for a sec, because you had mentioned earlier about, business acquisitions with real estate, and Charles has been hinting around the process and, being a little bit more with the 504. And I actually agree to a certain extent. Like when I see for example, a business acquisition that's 3.6 million, let's say for the business, and 1.2 for the building, my recommendation is always to do all of that with a 7A, just for simplicity purposes, because you're buying a business, and it's just so many different loans, so many different notes. It sounds like you have a different opinion, though. I want to hear it. You think that example, you think the 504 7A combo would be better?
No, I think for that example, a 7A, yes. So yeah, that's to Charles's point. Yes, that's it. And you asked what's in it for me, right? That's what WIFFM. What's in it for me? I would say in that example, probably all 7A. Too convoluted, too much. And again, if you are selling secondary market and you want to, as a borrower, I would tell my borrower, then try to negotiate that rate down. Or after 3 years, try to negotiate that rate. But if they're selling, they've got to get the secondary market to give the thumbs up. So in a situation like that, I would agree. It's do the whole thing 7A for sure. But you also have to look at guarantees. Do they want to do another building? Are they expanding? Those are the other things to look at, because now you're maxed out on 7A. So again, just kind of like being careful about, as Ken said, we've been talking about this, being their advisor. What do they want to do in the future? Because 504 has more. We have more money. You guys got more than like twice the amount. But I say you guys, but I do CA, so I dabble in the 7A market. But it essentially matters what is the best for the borrower. But I don't know if that answers your question, but
no, it does. I just wanted to clarify that point, because
I think your situation 7A all day long, all of it. Mm-hmm.
What
Okay,
if you
let's.
flipped it though? What
But
if it was a
if you
$3.6
flip
million?
it, 1.2, 3.6, 504.78 all day long, 100%. Absolutely. I would
And
absolutely say that. 3.6
I,
million on a prime plus 3 compared to 3.6 million on 6% and a blended rate of probably 6.5 or 7. Absolutely. Why wouldn't you do that? Because now you've opened up that 7A. They want to do another business acquisition. They want buy another CPA firm. You've got, because keep in mind it's 5 million, but it's really the guaranteed amount. So that's why we have to structure some deals appropriately and say, let the 7A go first because we can go full 5 million, if that makes sense. Like we've got that room where you don't on the 7A. So again, just to Charles's point, it matters what they're wanting to do. But yeah, if it's flipped, I do 504 7A.
let me make sure I understand, because it's been a little while since I've been doing the 504, but in those scenarios, it's a 15% equity injection on the 504, right?
Not necessarily. It depends on what it is. No, I mean, we start with 10. Sometimes
on an asset purchase of a business.
Oh, I'm sorry. I'm sorry. Well, again, it depends. Are they purchasing the existing business, the operating company that's been running? So again, all of these things matter. Do they have experience in the business? So is it a real startup or is it not? So we have to determine that on the front end to determine what the equity injection really would be. I'll tell you, we always are very careful when we talk about equity. We're always more conservative than anything. We'll say it's probably going to be a 15%. We might be able to get 10, but we need to dive in to see exactly how this would be structured to see if it would be a 10% equity injection, but we believe it'd be 15 because of this or this. And until we see, again, dive into when did they start generating revenue? How they generate revenue? Are they maintaining the same OC, right? Are they buying the actual business with the same OC? All of that matters.
Every deal's different.
I want to.
That's why we love the business.
We're gonna have to wrap this up. We're going much longer than I thought, but I love it. I'm just gonna throw. My whole question list is out the window, so I'm gonna toss this out to whoever can answer it best. But which product offers more risk protection? Being at 50% loan to value on a building, or having a 75% guarantee?
For the lender or
for the bank?
For the bank?
Bank.
For the bank, 504 is way safer. I mean, look, I represent Morgan Stanley, New York Life. Those are pretty conservative institutions. Why are they doing it? For CRA and 50% loan to value. In my entire career, we've had 3 loans go bad with Morgan Stanley, and we made money on all 3 because we sold the buildings. SBA's taking the risk, but at 50% loan to value, unless Charles's scenario happened with, I don't even want to say that again, you're not going to take a hit.
So why is it that the tougher deals are going 7A?
You can get them done.
PLP.
And the institutions that are the same ones that want the conservative 504 want quality conservative 504. They don't want high risk. So minimum debt coverage 1.0. They don't want projection-based deals typically. So they want to minimize their risk, still have access to capital for small business. So some credit boxes will be a 1.0 or 1.2 or 1.1, where 7A will do projection loans all day. 504 can, but the amount of first mortgage lenders goes down quite a bit when you talk about projection-based.
Mm-hmm.
Right. Because keep in mind, you're looking at a credit policy of a lender, of a bank, and their credit policy won't allow for them to hold a note for up to 90%. You know what I mean? Past the, whatever they're expecting as far as their balance sheet is concerned. So it's different. It's different because, again, we're partnering with another lending institution, which is typically going to be a lot more conservative. And because we can only finance, fixed assets, unless we're doing a debt refi, that's different. But, when you're only financing something that has a tangible worth on it, it's definitely, way less risky for a bank.
And even when you throw in your EBE, you're still at 50% loan to value on the first.
So we got eligible business expenses, but I tell bankers it's cash out refi, and there's limitations to that, but you can do a cash out refi, they're essentially working capital going forward, and you could do that, and they're still at 50% LTV, and 504 can come in at 40. So
that's how CDCs sell institutions on why participate in the SBA program. It's not, the first mortgage isn't an SBA loan. It's a conventional loan with SBA behind it.
That's exactly right. And that's what I was going to say. I think you brought that up, Ray, is that when we're working with a lender too, that's a good deal. And the 10% or whatever. And then, you're typically they will price those 504s better than they would a conventional loan because they're in a better lead position. They're at 50% LTV. Right. So, they'll price the 504 loans even better. So that's another advantage.
And frankly, if the world goes to, what in a handbag, the SBA is going to buy out the first to protect their interest. So there's two ways of exit for the first mortgage lender.
Well, one thing I think I've noticed a growing trend of, and this is not going to be affecting your world, Ken, or the 504 program as much, but in the 7A program, risk seems to be dying. And you talk about a bank, a regulated bank is not the one taking those high risk loans and going PLP. It's their 13, 14 licensees out there, and they're largely, owned by a hedge. It's the front office of a hedge fund who's put up a fixed amount of capital, and they're not going to maybe put up any more. But it's the secondary market that sort of decides, or whoever's providing that line of credit to the lender, that's who's deciding what risk is going to be taken or not. And it's always mommy may I for making a lot of these loans. And I know some of the processes we go through are not needed on particular loans, but we promised that we would do it on every deal. So we do it. And that's a tax on the borrower. And I remember, I believe it was Tony Wilkinson told me 20 years ago, that back in the 70s, the SBA, who was also a direct lender back then, if you had 3 banks decline your loan, then you go to the SBA and they would do your loan, period. And they were eating 10 to 12% loan losses those years. And the whole program was $3 billion. It wasn't a huge number, but it was a true stimulus program for small businesses. And that means for the economy and uplifting people into the middle class and on and on. And today, you got so many checklists, you go through so many processes, and oh my God, the articles of incorporation don't have a comma on it, so we got to take that comma off of all the documentation, and we're obsessed with checklists and crap that just don't matter.
Charles, that's a good teaser into maybe a future episode we'll do. And you
could call it deal fatigue.
Yeah, that's a good one. And guys, this was fantastic. We're running up against the hour, so we got to jump. But this was, I thought, an incredible conversation. Thank you so much for participating in it. Until next time, ta-ta. All right, that's it for this week's episode. If you want more SBA content, you can sign up for our monthly newsletter and check out our sister shows, SBA Today and The Media Show. We'll leave a link in the show notes. And don't forget to subscribe to this podcast so you never miss an episode of the Art of SBA Lending. Ta-ta.